We all know that insurance documents are very important to cover the risks of shipment during transportation of commodities and performances in international trade. Welcome back to the domain of my discussions on international trade and related issues. Today, we're tackling a crucial part of the UCP 600, Article 28, which covers insurance documents and coverage. If you're dealing with letters of credit, you know how vital insurance is for protecting goods in transit. Getting the insurance document right is non-negotiable for a compliant presentation. So let's break down Article 28, paragraph by paragraph, to make sure you get it right every time. First up, Article 28, paragraph A. This sets the foundation. It states that an insurance document, like an insurance policy or a certificate of insurance, must appear to be issued and signed by an insurance company, an underwriter, or their agents, or their proxies. The key phrase here is appear to be. The bank isn't expected to verify the authenticity of the signature, just that it looks legitimate and is from the correct type of entity. According to this sub-article, an agent or a proxy may sign on an insurance document. Any signature by an agent or proxy must indicate whether the agent or proxy has signed for or on behalf of the insurance company or underwriter. Now let's move to sub-article 28b. This deals with multiple originals. It says that if the insurance document indicates it was issued in more than one original, all of those originals must be presented. This is super important. For example, a bill of lading is often issued in a set of 3 originals. Similarly, some insurance policies are issued in duplicate or triplicate. If the document says issued in 2 originals, you must present both. If you only present one, the bank will raise a discrepancy. The reason is to prevent fraudulent claims. If multiple originals are floating around, someone could try to claim on the same loss more than once. By collecting all originals, the bank ensures they have full control over the insurance policy. Next, we have paragraph C. It says cover notes will not be accepted. So, if your letter of credit asks for an insurance policy, you can't just present a broker's cover note. A cover note is temporary and just confirms that insurance has been arranged, but it's not the final, binding document. Therefore, sub-article C prohibits for acceptance of a cover note instead of insurance policy or insurance certificate. It won't be accepted unless the letter of credit specifically allows it. Sub-article 28d says, an insurance policy is acceptable in lieu of an insurance certificate or a declaration under an open cover. This is just for a commitment implementation and primary note to accept. Now let us see what sub-article 28e says. It says, the date of the insurance document must be no later than the date of shipment. Unless the insurance document says otherwise, the cover is deemed to start no later than the date of shipment. The bank will look at the date on your transport document, like the bill of lading, and compare it to the insurance document. The insurance must be effective on or before that shipping date. Why? Because the risk to the goods begins the moment they are loaded for transit. If you get insurance that starts the day after shipment and the ship sinks on the first day, the goods aren't covered. The bank wants to see continuous coverage from the moment the goods are on their way, so always double-check those dates. Paragraph F is a simple but critical point. It says the currency of the insurance cover must be the same as the currency of the letter of credit. If your letter of credit is in US dollars, your insurance must also be in US dollars. You can't have a credit in euros and an insurance policy in Japanese yen. This avoids any confusion or loss due to currency exchange rate fluctuations when a claim is made. It keeps everything clean, straightforward, and consistent with the underlying transaction. Now for paragraph E, which is all. It says, a requirement in the credit for insurance coverage to be for a percentage of the value of the goods, of the invoice value or similar is deemed to be the minimum amount of coverage required. This one causes a lot of discrepancies, so pay close attention. This sub-article also says, unless the letter of credit specifies a different amount, the insurance must cover at least 110% of the CIF or CIP value of the goods. What are CIF and CIP? They are Incoterms, meaning cost, insurance, and freight or carriage and insurance paid to. In these cases, the seller's invoice price already includes the cost of the goods, the insurance, and the freight. The extra 10% is there to cover the buyer's anticipated profit or other incidental costs they might incur if the goods are lost or damaged. For example, if your CIF invoice value is $100,000, your insurance must be for at least $110,000. If the letter of credit doesn't mention CIF or CIP value, the bank will use the value of the drawing or the gross invoice value, whichever is greater, to calculate the 110%. Let's look at sub-article F Roman 3, which is about the risks that need to be covered. It says, the insurance document must indicate that risks are covered at least between the place of taking in charge or shipment and the place of discharge or final destination as stated in the credit. Then sub-article 28G. It says, a credit should state the type of insurance required and, if any, the additional risks to be covered. An insurance document will be accepted without regard to any risks that are not covered if the credit uses imprecise terms such as usual risks or customary risks. This is where it gets detailed. The letter of credit will often specify the types of risks to be covered, for example, all risks. If the letter credits requires all risks coverage, and your insurance document includes a clause titled all risks, it will be accepted, even if it contains exclusions. Banks are not insurance experts. They don't analyze the fine print of the exclusion clauses. They simply check if the document has the required all risks wording. This is a classic example of the principle of strict compliance in letter of credit operations. The bank checks documents on their face, not the underlying realities of the insurance coverage. Sub-article 28H says, when a credit requires insurance against all risks and an insurance document is presented containing any all risks notation or clause, whether or not bearing the heading all risks, the insurance document will be accepted without regard to any risks stated to be excluded. Sub-article 28I refers an exclusion in insurance documents. It says an insurance document may refer to exclusion clauses. This is perfectly normal. Almost all insurance policies have exclusions for things like war, strikes, riots, or inherent vice of the goods. As we mentioned, banks will accept a document with these exclusions without question, as long as the document itself meets the letter of credit requirements. They are not expected to be lawyers or insurance specialists. Sub-article 28H addresses what happens when a letter of credit is silent on the specific risks to be covered. In this rare case, banks will accept an insurance document as presented without regard to the risks it covers. This puts a lot of responsibility on the applicant, the buyer, to ensure their letter of credit instructions are precise. If you're the buyer and you don't specify the risks, you might end up with very limited insurance coverage that doesn't protect you properly. So always be specific in your letter of credit application. Finally, we come to paragraph I. This paragraph deals with the concept of a franchise or deductible, which is the portion of a loss that the insured party has to bear themselves. An insurance document may state that the cover is subject to a franchise or an excess, also known as a deductible. Unless the letter of credit specifically states that the insurance must be without a deductible, banks will accept a document that contains one. For example, a policy might say it has a deductible of $500. This means for any claim, the insurance company will pay out the amount of the loss minus $500. This is common practice in the insurance industry to discourage small, frivolous claims. If the buyer wants zero deductible, they must explicitly state that in the letter of credit. So there you have it. A complete walkthrough of UCP 600 Article 28. To recap, the document must be from an insurer. You need all the originals. Coverage must start by the shipment date. The currency must match the letter of credit. The amount is usually 110% of the CIF or CIP value, and banks accept documents with all risks and exclusion clauses at face value. Understanding these details is key to ensuring your insurance documents are compliant and your payment is secure. It prevents costly delays and disputes. I hope this detailed breakdown was helpful for you. Navigating the UCP 600 can be tricky, but by taking it one article at a time, it becomes much more manageable. If you have any questions, drop them in the comments below. Thanks for watching, and don't forget to like, subscribe, and hit that notification bell for more videos on international trade finance. See you in the next one.